A popular phrase among investors and analysts is the bond market is always right, from predicting downturns to the Federal Reserve's next move. The bond market's historical forecasting track record and its wisdom of the crown quality have given it a near-mythic reputation among Wall Street analysts, but it's becoming increasingly clear that the bond market is reading the economic tea leaves all wrong. Right now, the bond market suggests that the economy is on the verge of a hard stop and a recession that will force the Federal Reserve to cut interest rates to stimulate activity. Actual economic data, on the other hand, points to hardly gangbusters but continued growth for the U.S., and the longer the market expectation diverges from the economic reality, the more painful the market adjustment will be once it happens. Stocks are pricing in some earnings recovery and a generally strong economy. U.S. indexes are up about 10% over the past 6 months, while markets in Europe are up even more. So if the bond market ends up being right about the economy, there would be a serious, ugly wake-up call for the stock market. The Fed slowed down its interest rate increases because of the Silicon Valley Bank disaster in March, and I suspect they will pause completely at the June meeting to signal that they're taking an extra cautious approach to the financial system mess. But if the economy ends up holding up relative to expectations, the Fed's job may not be over. Instead of the interest rate cuts that the bond market is pricing in, the central bank may be forced to restart rate hikes later in the year to cool off any fears of inflation kicking back up. If the Fed hikes rates again, the resetting of expectations would slam markets. For stocks, the hope for lower interest rates would be dashed, and there could be a sizable drop as the new reality takes hold. But the stronger economy could provide a cushion, since higher consumer demand would help keep profit expectations afloat. On the other hand, the bond market would take it squarely on the chin. A sudden expectation shift from a weaker economy and lower interest rates to a stronger, high interest rate environment would send yields soaring and bond prices tumbling. And the longer investors hold on to the idea of rate cuts, the worse the eventual dislocation will be.